Couple that we work with who retired last year with about $1.2 million saved, primarily in their IRA and then some taxable money, spent about $140,000 in their first full year of retirement. And when they filed their taxes, they owed the IRS exactly $0. Federal income tax, zero. But here's the crazy part. Their good friends who retired at the same year spent nearly $110,000, but paid $11,000 in federal income tax. So similar income levels, same state, but what did our clients know that their friends didn't? Well, I'm going to show you that exact strategy over the next few minutes, but I do need to warn you. There are 3 traps that will destroy this if you don't see them coming. And one of them is hiding in plain sight on almost every retiree's tax return. Here's what this looks like in practice. You can withdraw 6 figures from your accounts, spend every penny, and legally pay $0 in federal income tax. Not because you're hiding money, not because you're using some loophole the IRS is about to close. This is a tax code working exactly how Congress designed it, but only if you set it up correctly. And the reason most retirees miss this, they make one of the 3 mistakes in the first year of retirement. But before I tell you what you need to avoid so you don't end up paying thousands more in taxes than you might actually need to, let's talk about the actual strategy first. The IRS gives you 2 massive gifts in retirement, and most people don't use them together correctly. Gift number 1 is the standard deduction. In 2026, that's $32,200 if you're married filing joint, $16,100 if you're single. This is income that you can have without paying a dime in federal tax. Now, gift number 2 is the 0% long-term capital gains bracket. In 2026, if your taxable income stays under $98,900 as a married couple or $49,450 as single, your long-term capital gains are taxed. They're just taxed at 0%, which is our favorite kind of tax. And one quick clarification, because it matters. Those 0% thresholds apply to your taxable income after deductions, and the space is shared by long-term capital gains and qualified dividends or other type of qualified income combined. So most retirees waste these gifts. They either take too much from their IRA and blow past the standard deduction into the 10, 12, or even 22% bracket, or they leave money in taxable accounts and never realize they could be harvesting gains for free potentially. So smart retirees do something different, right? They take IRA withdrawals up to exactly the standard deduction amount so that the entire withdrawal is sheltered from tax. And they fund the rest of their spending by selling investments in their taxable account, where only the gain portion is taxable, and they keep the gain inside the 0% tax bracket like we just talked about. Now, 2 important assumptions before we run the numbers. This works best if you're selling shares you've held for longer than a year. So the gains are taxed as long-term capital gains versus short-term capital gains, which are taxed as ordinary income. And also, your tax outcome depends on your cost basis. So the gain portion could be bigger or smaller than my example. Now, let me show you how this actually works with real numbers. Let's say you're a married couple and you retired on January 1st, 2026. No more paychecks. You don't have Social Security or a pension kicking in yet. Just you, your IRA, and your brokerage account. And you want to spend $120,000 this year. Also, quick disclaimer, we're talking federal income tax here. State taxes can be a different story depending on where you live. So just want to make that note. Now, here's the play. Step 1 is to withdraw $32,200 from your traditional IRA. That entire amount gets sheltered by your standard deduction. Your taxable ordinary income, 0. So step 2 is you need another $87,800 to hit your $120,000 spending goal. This is where you get your taxable brokerage account to come into play. Now, here's the key that most people miss. When you sell stock in a taxable account, you're not taxed on the full amount that you receive as a distribution. You're only taxed on the gain, the difference between what you paid for a position and what you sell it for. So your original investment or your cost basis comes back to you completely tax-free. So let's say the stocks that you're selling have a 60-40 split. 60% of what you get back is your original money and 40% is gain. If you sell $87,800 worth of stock, only $35,120 of that distribution is going to be taxable as long-term capital gains. And remember, that 60-40 split is just an example. Some accounts might be 80-20, some might be 30-70, and some might be 90-10. And that's why we look at actual tax loss and cost basis when it comes to your taxable accounts. Step 3 is to check your work. Your taxable income for the year is basically just $35,120 in long-term capital gains. So you want to make sure that that's actually accurate for your picture and for this example. Now, the IRS says that 0% long-term capital gains brackets go up to $98,900 of taxable income for married couples in 2026. You're at $35,120, so you're not even close to hitting the ceiling. Bottom line, Well, you just spent $120,000 and your federal income tax bill is $0. Now, let me blow your mind a little bit more. Same couple, same setup, but this time they want to spend much more and really enjoy their first couple years in retirement. So they want to target $180,000 in spending. Well, step one is going to be to still take the same $32,200 from the IRA and it's still shelter. Step two, now you need $147,800 from the taxable account. Using the same 60-40 split, you generate about $59,120 in long-term capital gains. So you're still under the $98,900 threshold. So your federal income tax, still zero. Think about that. You spent $180,000. You only paid tax on $59,000 worth of gains, and even that was taxed at 0%. This is a tax code working exactly as designed. And this is what I mean when I say that the smartest retirees think in terms of tax buckets and not just overall balances. But remember those traps that I mentioned at the beginning of the video? Well, let's make sure you know the three that I want to outline so you know what to avoid so you don't pay more in taxes than you need to. Now, mistake number one, you retire mid-year or early in the year and you forget that you had a paycheck for part of the year. This happens all the time, unfortunately. Someone retires in March, they're excited, and they're finally done working. When they sit down to plan their retirement income for the rest of the year, they completely forget that they already earned maybe $25,000 or $30,000 in January, February, and March. So they withdraw money from their IRA, they sell some stocks, and when the tax bill comes, they realize that they just paid thousands in federal income tax that they didn't need to pay because they didn't account for those additional W-2 earnings at the beginning of the year. So if you retire anytime other than before or on January 1st, I guess, you need to treat that partial year income as the first layer of income on your tax return. Don't ignore it. Don't forget about it because W-2 income does change everything about how you should be pulling money during the first part of the year. So how do you avoid making that mistake? Well, first, you do need to understand the two IRS gifts that make this whole thing possible, which is what we just covered. Then you, preferably you or your advisor, should be updating at least quarterly your tax pro forma. So what's a tax pro forma? Well, it's basically a log of all of your different income sources throughout the year. It's the way that you're able to track how much income you're expecting to have, what your taxable income might be, what your modified adjusted gross incomes might look like, and allow you to be more proactive on your tax planning strategy rather than reactive in April the year following. Now, mistake number two is when one spouse retires, but the other one keeps working. This is so common. Maybe you retire at 62, but your spouse keeps working until 65. If your spouse is bringing in $60,000 or maybe $80,000 in wages, you've completely blown through your standard deduction before you even think about an IRA withdrawal or capital gains. The plain 0% federal income tax story, unfortunately, that's gone. But you can still do strategic planning. You can still control your tax bracket management. You can still potentially do micro Roth conversions in low income years if it makes sense for your plan. But the picture perfect $0 tax bill just isn't going to happen when you do have W-2 wages or really any income for that matter. Now, the fix is quite simple. Treat the working spouse's wages as your base layer of income, just like we talked about in the first trap, and plan everything else around that. Don't try to force a strategy that doesn't fit your situation, especially if your spouse is enjoying working or if your plan needs the income. Now, trap number three is the one hiding in plain sight like I warned you about at the beginning of this video, and that's going to be your qualified dividends. If your brokerage account is kicking off $15,000 or maybe $20,000 a year in qualified dividends, depending on the value of your taxable accounts, those count against your 0% capital gains limit. They're taxed the same way as long-term capital gains, which means they're eating into your available room before you even sell a single share. And it's not just dividends, it's interest too, it's bond fund payouts, and it's even mutual fund capital gain distributions that can show up and take space as well. So let's get back to our married couple spending $120,000 per year. They did the math perfectly, $32,200 from their IRA, $87,800 from selling stock, generating $35,120 in gains. This is all kind of a recap for you. Their federal tax should be zero, right? But then December rolls around and the brokerage account pays $18,000 in qualified dividends. Now their total taxable income isn't $35,120, it's $53,120. They're still well under the $98,900 ceiling, so they're still in the 0% bracket for long-term capital gains. It's just they used up $18,000 more of that tax base that they weren't accounting for. So if they wanted to spend more, or they wanted to maybe do a micro Roth conversion if it makes sense, or realize more gains, they might not be able to because the dividends took that room. So The lesson here is just that you need to know what your dividends and your other investment income are going to do before you plan your withdrawals. I like to call this your leaky income. Don't assume that your taxable account is just sitting there doing nothing. It's probably going to generate income whether you want it or need it or not. Now, a quick warning, if you are retiring before age 65, if you're buying health insurance on the ACA marketplace, this entire strategy might cost you more than it saves you. Why? Well, because ACA subsidies are based on your income, specifically your modified adjusted gross income. And it's not the same as your taxable income. Modified adjusted gross income includes your IRA withdrawals and capital gains, even if you're still engineering a 0% federal income tax bracket. So you could be engineering a perfect 0% federal income tax return, but lose $5, $10, or maybe even $15,000 in premium tax credits. Unfortunately, I have seen this happen, and that's why retiring before 65 does require a different calculation. You're not just optimizing for taxes, but you could also be optimizing for healthcare subsidies as well. And it's why it's so important to really see the bigger picture of your whole plan and understand what your objective is for that year and the consecutive years, and then be able to execute on it. That's why we like to break our retirement clients into phases, right? Phase 1 is potentially COBRA right after retirement. Phase 2 is maybe ACA Marketplace if you're retiring before 65. Phase 3 is your Medicare before RMDs. And Phase 4 is Medicare after RMDs. So it's really important to understand what the goal is, what your overall objective is, and then how you should be strategizing to execute on that. So if you're retiring in 2026, you got no wages, no Social Security, no pension, and you've got money in both your traditional IRA primarily and a taxable brokerage account, you can absolutely engineer a six-figure lifestyle with zero federal income tax. But it does require precision. You need to know your numbers, you need to control your income sources, and you need to understand how every dollar you pull affects your overall total tax picture. Now you know exactly how to withdraw six figures in retirement while paying $0 in federal income tax by coordinating your IRA withdrawals with your taxable account sales. But here's what I didn't answer. Which account should you pull from first? Should you drain your 401k before you claim Social Security? Should you delay your pension if you can, and if you even have one? Or should you tap your taxable account early on and let all those other ones continue to grow? Because the order you withdraw from these accounts can cost you or save you tens of thousands of dollars over your retirement. So if you want to learn the exact withdrawal order that protects your wealth and minimizes your lifetime tax bill, click this next video where I break down the 401k versus Social Security versus pension decision.